Hello and welcome to Market Domination. I'm Julie Hyman. That's Jared Blickery in for Josh Lipton today, live from our New York City headquarters. We're here to give you the ultimate investing playbook to help you tune out the noise and make the right moves for your money.
From today's top investing stories to Yahoo Finance's trending tickers to the macroeconomic forces shaping markets, we're going to dig deeper into everything you need to know for the last hour of trading.
And here is your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Broadly, the distribution is not as worrisome. It's probably why you're not seeing as much of a negative reaction for the market today. So January, February, to me, looks like they kind of cancel each other out for both the jobs report and the CPI report.
There's some de-emphasis on this month's report, given markets have already recalibrated the expectations for when rate cuts are going to happen. It's hard for the Federal Reserve to make the case that, even though they kind of are signaling they want to cut rates, it's hard for them to make the case that they should cut.
This legislation does not enact a ban on TikTok. What this does is requires ByteDance, the owner of TikTok, it requires them to sell TikTok to some kind of another entity.
We've got 1 hour to go until the market close. Jared and I getting you up to speed now on the market action. We start with the major averages here. We did, of course, have that CPI data this morning that came in a touch hotter than economists had been estimating. It has not slowed the rally, however, and largely doesn't seem to move the needle on expectations for the Fed's interest rate cutting cycle. We do see the Dow right now up about 279 points. That's a gain of 0.7%. We have had some volatility, however, today in the wake of those numbers this morning. The S&P 500 up better than 1%, and tech is leading the pack and holding up well in today's session, up by 1.4% right now. I also want to take a check on the 10-year note, because that, of course, is one reflection of interest rate expectations. We are seeing a 5 basis point gain in that to 4.15%. But if you look at it compared to where we've been as of late, it's back to where we were, call it earlier in February. So it's not as though it's seeing a big tick up at this point in time. Now I'm going to send it over to Jared for a stock name that we are watching.
Julie, I am watching shares of Boeing down in today's trading as more negative headlines. There you can see down about 4.6%. More negative headlines about the airline manufacturer. The FAA's audit, the New York Times has found, they found dozens of issues with the 737 MAX jet production process. And this comes after 50 people were injured on board a Boeing jet when, of course, they were suddenly dropped when this plug was dropped out of the fuselage. The airline blamed the event on a technical event, but we are seeing shares today of Boeing down about 5%, as I said. And then you check out the travel heat board on the Wi-Fi Interactive, and I'm going to show you, you can really see the airlines that are affected here because it's only two. Southwest down 15% in that little red square there, and American Airlines down 5%, Julie.
But this is affecting many more of the airlines than just those two. I mean, Southwest did say it plans to cut capacity this year. It plans to stop most hiring. It plans to review its spending. And a lot of this has to do with the fact that it is getting fewer aircraft from Boeing this year than it expected. So this has really thrown a wrench, not only obviously into Boeing's business, but there's been this big ripple effect. Spirit Air Systems, obviously, which is one of the big suppliers to Boeing, both has been, blamed for some of this, but also has felt the effects of some of this.
Yeah, and what I take out of this is that we have not seen the full effect of this the re-rating down cycle in some of these airline stocks. So incrementally bad news is also meaning more bad news for the airlines. So this is yet to be a closed matter.
Yeah, and the United CEO also is saying that they don't even want the 737 MAX 10s that they had ordered because of concerns over whether it's eventually going to be certified.
It's an existential problem for Boeing, perhaps.
It seems that way, and we're going to talk much more about how to play it with the airlines a little bit later on in the show in our playbook. But in the meantime, let's widen things out once again and talk about what's going on in the market today with stocks higher as inflation pressures remained persistent in February. Now with the tension shifting back to Jay Powell, investors are trying to map out when that first rate cut may be coming. For more, let's bring in Liz Young, SoFi Head of Investment Strategy. Hey, Liz, it's great to see you.
Hello, good to be here.
So, you looked at these numbers this morning, and I have to say, you might have expected to see quite a different equity market outcome with those numbers coming in a little bit hotter than estimated. So what happened?
What I think is going on right now, and I don't want to say that the macro data doesn't matter, it certainly does matter, but I think equity markets are first and foremost queuing off of what Jerome Powell sounded like last week. He sounded pretty dovish. He sounded like they were still planning on cutting rates at some point this year, which is what we were expecting. And if you look at the Fed funds futures, they didn't really move at all, regardless of the fact that CPI came in hotter than expected. So still looking for that first cut possibly in June, and still looking for about 3 cuts by the end of the year. So that didn't change much at all. When you look at what the numbers were, we got some hotter CPI numbers in January. We've heard the explanation that this is seasonal. This happens in the beginning of the year. So I think we had a little bit of a buffer to expect slightly hotter numbers than what the survey said. But like you said, the odd reaction here is that you've got tech leading today. So that sector that's the most interest rate sensitive on a day when yields are up in response to inflation data. And the other thing I would point to is the Fed cues off of inflation expectations as well, because the last thing they want is for inflation to become entrenched. And the way that they measure that, one of the ways they measure that is by looking at inflation expectations. And a way that you can measure inflation expectations is by the break-even rates. And if you look at the 2-year break-even rate, it's gone up more than 75 basis points since the end of November. That is a really big move. The 5 and 10-year rates haven't moved much, but that 2-year rate has gone up quite a bit. So that means that inflation expectations are rising. And the risk here, I think, really to the equity market is that the Fed has more stamina, a higher threshold for pain than stocks do. So people keep buying. And what if the Fed says, we're not ready to cut yet because the data doesn't tell us that it's the right time?
Liz, fascinating comments then. So let's think through to the next FOMC meeting. Where do you see the dot plots landing, and how do you think Powell will characterize, what will be the tenor of his tone? Will it be hawkish, dovish? Is he going to have to walk back some of the expectations that have been built in for these rate cuts, which remain today?
Well, luckily for him, they haven't given many concrete expectations about those rate cuts. They've been intensely vague about what they intend to do. And I think that's been on purpose, and that's been the safe route. He's continued to say that phrase of, we need to feel confident that inflation is on a sustainable path toward 2%. What we're seeing in the data, obviously CPI is different than PCE, but what we're seeing in the data is that it's plateaued. So it's not necessarily going back up at a concerning rate, but it has plateaued. We had this huge drop off of peak inflation, and now we're at this place where I heard the joke recently that last 5 pounds that you're trying to lose is always the peskiest, and that's where we're stuck. And the thing that's keeping it stuck there is services inflation. Now we can explain some of that away by saying it's all shelter, it's everything in the housing market that's skewing it, and that's such a lagged effect. And some of that is true, but we're starting to see other little pockets pop up as problems, something like auto insurance. We've never talked about auto insurance being an issue before, and now suddenly auto insurance is an issue. So I think what we're going to see for the next few months is inflation data that isn't as promising, perhaps, as we were hoping it would be. And I think Powell is going to have to acknowledge that. But to be fair, I think he has acknowledged that. And the market just is choosing to decide for him what we think the Fed is going to do later in the year.
Yeah, Liz, I like that last 5 pounds analogy too. It's a little more evocative than the last mile, right? Like, why is it so hard to do the last mile? We know it's hard to do those last 5. So if inflation is going to be more persistent, if we're going to hear maybe more talk from the Fed about that, what effect does it then have on your investments, right? What effect does it have on risk assets, for example, which, as you noted, are still doing pretty well today?
Right. Well, and today may end up just being an anomaly, sort of a strange reaction in the market on the idea that the economy is still strong. Yes, inflation has come down, but we can withstand it and absorb it. What's interesting about what's happened even since last October is as we continued to push rate cuts out, stocks still did okay. They still, in the face of that, did okay. So if the idea was that things had fallen into October due to the idea that things were getting worse or because rates had risen again, it turns out we ended up absorbing it just fine. I don't know how long that can last. Again, I go back to my earlier comment. I think the Fed's stamina is stronger than the market stamina here. But the way that so far the market has tried to withstand it is by rotating. And now that's not happening as much today, but rotating out of some of those very obviously crowded trades, very obviously overbought certain stocks or even certain themes or sectors or whatever the case may be, and rotating into other parts of the same sector. So maybe out of really big cap tech that's seen a good run and into some of the old school tech that hasn't kept up as much, or rotating into more cyclical sectors that have lagged for the better part of the last 12 months. So that's how the market has been digesting this and still showing strength. And that's where that broadening out narrative has come from as well.
Liz, I'd like to stick with this broadening out narrative and talk a little markets and further sector action. You mentioned a couple of sectors broadening out from the tech rally. Materials is one, too. Healthcare is another. Financials, industrials. There have actually been a broad base of support here from some of these other industries. I'm just wondering what you happen to like or see as potential in particular.
Those are definitely the ones that have proven the broadening out narrative. The healthcare one, it has been there for a while, and I think that's much more of a thematic move, the weight loss drugs and everything that's happened along that vein. But materials, industrials have had a really nice run. Materials, I think, are responding to the idea that inflation isn't in fact falling, or that we don't have deflationary pressures, and that perhaps the economy is stronger, which means that global demand should stay stronger. Energy has come off the mat a little bit, and then you mentioned financials. So I think some of that is that rotation back into, okay, what if we are more mid-cycle than late cycle? What if the economy musters through this and we manage to have that soft landing, or at least solidify that soft landing, in which case cyclicals should do well coming out of that and should survive any little contraction that we may have. So I think that's part of what's going on here. What you do want to see, though, is that investors, and this has happened, investors come in when we see little pullbacks and buy different things. And that shows us that, okay, we didn't have to rely on 7 names in the index to carry us all the way through the year. Now maybe we can look to other sectors to pull some of their weight. The concerns that I still have are that I still believe that we are more late cycle than mid cycle. I believe that we're in a period where this is a very elongated late cycle, perhaps the longest one that we've lived through, but I still believe that there's late cycle behavior going on. And the big question is, are we seeing late cycle euphoria driving markets upward, or is this more of an expansionary phase that you would see early or mid cycle? I think we're seeing a little bit more late cycle euphoria, which you could also call something like the FOMO trade.
Well, we definitely seem to have seen evidence of that, Liz. Thanks so much. Really appreciate it.
Thank you.
We're just getting started here on Yahoo Finance Live. MicroStrategy announcing this week they're buying another 12,000 Bitcoin as the crypto token continues to set new highs. I'll speak to MicroStrategy's executive chairman, Michael Saylor, about the company's latest moves at 3:30. And airline stocks are sinking today amid the latest woes from Boeing. We're joined by an analyst later this hour to discuss how investors should play the sector. Got all that and more when Market Domination comes back.
The Fed still searching for confidence to cut. Following today's hotter than expected inflation data, that's a takeaway from our next guest, who believes the CPI print was fairly encouraging, but it may not be enough to Jay Powell and company to begin lowering short-term rates just yet. Sarah Howe, senior economist at Wells Fargo, joins us now. Sarah, thank you for joining us here. We've been talking about inflation for the last 10 minutes or so. Just wondering what your first blush comments are in reaction to today's report, and maybe thinking ahead a little bit to the next FOMC meeting.
Sure. So on the headline, of course, we saw a slightly stronger core inflation number than what was expected. But digging into the details, I don't think it was as bothersome as maybe that overall first read indicated. So we did see some stronger numbers from the goods sector, but I think that is tied in part to some residual seasonality. And importantly, we did see some cooling in the service sector, which was really driving that upside surprise in January. So I think overall, the disinflationary trend is still in place, even if progress is slower going of late.
And slow and I guess choppy also we could describe it as, right, Sarah? Because as our previous guest brought up, we saw a big spike in car insurance of all things. Mm-hmm. Non-prescription drug prices were up almost 10% as well. And so how unusual is it to see those kind of random, for lack of a better word, or unexpected blips of bigger increases?
It's really not that surprising. It's just that over the past cycle, we didn't tend to notice the vacillation in terms of some of these month-to-month readings of various components, just because the magnitude was a lot smaller. So you're still seeing some of that normal month-to-month volatility, but it's just amplified given that we are still in a higher pricing environment. But I think, again, overall, you're still looking at an environment where I think the trend is still downward as we do see underlying pressures in the economy continue to subside.
Well, let me ask you, the last few months, the rhetoric and the narrative has been is that the inflation numbers are coming down, which they really have, but some of them have been turning sideways. Some of them on shorter timeframes have been turning up. I would note that Supercore, even year over year, Supercore ex-housing is holding north of 4%. We have a chart here. And what do you think the Fed is seeing when they see this? Do you think they dial back expectations for rate cuts, or what do they do at the next meeting?
So the Fed was already looking for core inflation to be a little bit stickier than I think a lot of other economists heading into the January and February data. So I'm not sure how much this changes their underlying view of where inflation continues to go throughout this year and on into next year. But I think on net, where you have seen some firmer readings of late, I think that does give them a little bit more pause. And I think it does make them perhaps a little less confident in terms of cutting rates here imminently.
So, Sarah, what does all of this mean for the dot plot, for example, which we're going to get at the Fed's next meeting? We're not likely to get any kind of movement on rates, but maybe we'll learn a little bit more about the current thinking, get an update to that. How many cuts are we going to get this year at this point? Where do you think consensus lies?
Well, we saw with the December summary of economic projections that the median expectation was for 75 basis points of cuts this year. Now, if we look at the distribution of that, it did skew somewhat higher. So it doesn't take many Fed officials for that median dot to drift up a little bit and imply only 50 basis points of cutting. But I think you're likely to still see that most participants are penciling in some degree of easing this year, even as inflation isn't likely to get all the way back to target, just because policy still remains restrictive in terms of that real Fed funds rate.
Do you see any pressure emerging from the labor market to fuel the Fed's decision one way or the other? I know it's a week after the last monthly payrolls number, but what do you see in the weekly numbers, or just looking ahead to the next jobs report inside the labor market? Any way that could influence the Fed's decision materially one way or the other?
Yeah, absolutely. The labor market is so important into how the Fed's path unfolds this year. You know, we're still focused on inflation, just given how high that's been over this cycle, and of course the the surprises we've seen over the past 2 months. But I think the labor market is the other side of the Fed's mandate. And while the headline numbers in terms of payroll growth remain very strong, I think we are seeing some broad softening underneath the surface. So not only did we see the unemployment rate edge up to a 2-year high last week, but you're seeing, I think, just broadly weaker household survey, whether it's part-time employment outpacing full-time. When we look at the establishment survey, you're also seeing a troubling trend in terms of temporary health services. We've seen those hiring plans from small businesses come down to the lowest level since 2016. So I think you are seeing more and more signs that the labor market is cooling off and doesn't need to cool much further, if at all, in order for the Fed to get labor cost pressures to a point where they're not adding to 2% plus in inflation.
All right, Sarah, we have to leave it there, but thank you very much for joining us today. Time now to dig a little deeper into some analyst calls of the day, starting with Bank of America raising its 2024 earnings per share, that's EPS target for the S&P 500, citing a virtuous cycle in AI investment paired with a new labor productivity. They raised their EPS target by 12% for the year end to $250. And Julie, they are now a street high, and they're touting that in their own report. They're happy to be there. I would say Savita Subramanian and the other teams there, they've been ahead of the pack. They were quite right last year early on when a lot of other analysts were negative, but they've come around, and now this earnings per share that puts them at $250 for this year, $275 for next.
Yeah, and I think it's so interesting that AI has gone from being a specific company story or even a sector story to really more of a macro story, right? I mean, because they talk about that quote unquote virtuous investment cycle. They talk about new economy investing as the old economy cuts back. And this is, according to Bank of America, a flip of last year when we saw the so-called hyperscalers, the companies like Microsoft and Amazon and Alphabet that were cutting back while the rest of the S&P 500 was investing. Now you've seen a flip of that situation, but obviously the team over there sees this as enough to boost that EPS number.
Well, and for all the talk about share buybacks and dividends, investors can also get a return on their capital through capital investments, or capital expenditures. And here's another line from the report. Hyperscalers, this includes Microsoft, Amazon, Google, Meta, expected to spend $180 billion on capital expenditures this year. That's up 27%. So just an amazingly high number that's going into the future, basically.
Yeah, it's pretty. And then on the old economy side, just one more quick note. They also say they see a manufacturing upgrade and perhaps a restocking cycle, right? Because you had over inventory.
We've been in a manufacturing recession.
Right, and then you had an inventory correction, and now I guess the correction to the correction would be that restocking taking place.
Correction to the correction is up, guys.
Yeah, exactly. All right, let's talk about another analyst call right now. This time it's IBM. Those shares are trending today, and they're up almost 3.5%. Bank of America behind this call, too, coming out with a bullish note on the company's future. Analyst Wamsi Mohan saying that IBM is repositioned for substantial growth and suggested that artificial intelligence boom will be similar to the internet in its power to unleash growth. And so that's part of it. We should also note that there is a new report just out from CNBC saying that the company, that IBM that is cutting some employees in its marketing and communications division, that it's told them that it is cutting the size of its staff. However, that IBM note from Bank of America doesn't really have to do with cutting, or at least not directly, but it does address the idea that AI is already starting to replace some other types of roles, programming and such within the company.
And it's elevating the roles of so many people. I'm finding completely unlikely uses for ChatGPT in my own life. I can only imagine what's being done at the corporate level. And it's not like it's eliminating jobs so much as allowing people to do that much more. Some of the longer term charts on productivity where we've seen just the productivity sideways slant or trade for years and years, it is now just breaking to the upside. So just based on that alone, there's a lot of upside potential potential. Just want to go to the Wi-Fi Interactive if I can real quickly. I have a max chart of IBM going back to the early 1970s, maybe even the late 1960s. But we see some big consolidation patterns here. One was in the late 90s and the early 2000s in the aughts. That resolved itself to the upside. We are now in another one which came just below into the other. Consolidation is now accelerated to the upside, and we would probably pause here, but I would expect if we break to the upside, well, you've got another huge burst just waiting to happen.
We'll see.
Potentially.
We'll see. I mean, Bank of America says that the AI business at IBM is already a $100 million book of business, and it's growing. So.
Yes.
That could fuel further gains in the stock. All right, coming up, Bitcoin reaching new highs this week, leading to some major investments into it. On the other side of the break, MicroStrategy Executive Chairman Michael Saylor joins the program to discuss the most recent move. Stay tuned, more market domination still to come.
Welcome back to Yahoo Finance. Crypto has been on a wild ride this week and can see a lot of red behind me. That's mainly Bitcoin and Ethereum. I'm going to check on the Bitcoin price right here. You can see a little bit of action here earlier off of the CPI print perhaps, but I want to get a 7-day look of the crypto heat map to really eliminate some of the noise here. We've seen a lot of other tokens, coins rise in value. Binance token in the upper left up 26%, Solana up 14%, Litecoin had a huge day yesterday, also up about 14%. So we've seen some of the altcoins come back and challenge the majors. Julie.
Thank you very much, Jared. Appreciate it. Well, despite declines for Bitcoin today, MicroStrategy shares, Well, they're higher. TD Cowen raising its price target on the stock to $1,560. That's $1,560 after MicroStrategy increased its Bitcoin holdings by another 12,000 Bitcoin. The total holdings about 205,000 now. Joining me now, MicroStrategy Executive Chairman Michael Saylor. Michael, it's good to see you. It's been a little while.
Thanks for having me, Julie.
So I want to start. I know that you're bullish on Bitcoin. I think everyone knows by now that you see a long-term store of value in Bitcoin. And you have said that you see it as digital property as opposed to thinking of it as a digital currency. So if you could help me understand, as you add more to the company's balance sheet, what the sort of end game is for those holdings on MicroStrategy's balance sheet.
Yeah, well, we think Bitcoin is the highest form of property. It's the apex property in the world, and it's the best investment asset. So the end game is to acquire more Bitcoin. Whoever gets the most Bitcoin wins.
Well,
there is no other end game.
But Michael, I guess what I'm trying to understand is, so if I think of it as digital property, and I think of analogies, right? I think of a real estate company that buys property and holds on to other kinds of property. They may not be the apex, but whatever kinds of property. I think of an asset manager that buys all kinds of different assets. Eventually, they sell those assets in order to make profits. But I don't think that is your end game, right? You're not planning to sell the Bitcoin at any point. So kind of what is the purpose of it over time?
Well, let's keep in mind the fundamental principle. What's the use case of Bitcoin? It's capital preservation. So if you have $1 billion and you live in South America, or you live in Asia, or you live in Africa, and you want the capital to last for 100 years, you're not going to want to buy $1 billion company or $1 billion building or $1 billion of land in any place in Africa. You're going to have to find some other form of property that you can hold for a long period of time. Let's take New York City. Developers of New York City in 1776 didn't have an end game. They've been raising capital to invest in New York City real estate at the all-time high for 300 years. If you went and talked to them today and you said, what's your end game? They would say, well, we're going to keep investing in New York City. If you've ever talked to a person that owned an apartment in New York City, no one aspires to hold the apartment for a few years, sell the apartment, and move out of New York City. They put it in their will, they give it to their children, and if you ask them why, they say there's no better place on earth to live than New York. There is no place up from there. So New York City is the end game for people that want to live in the greatest city in North America. Bitcoin is the end game for anybody that wants to own the greatest property in the 21st century.
Well, I guess that is the case, but is there a price at which you would consider selling some of the Bitcoin, pulling out? So, I mean, because you can do something with New York City. You can live in New York City. You can have a business in New York City. What do you do with the Bitcoin besides it just gather value?
Well, the real estate developers in New York City, they're not buying the real estate because they want to live in it. They're buying the real estate because they expect
because they want to sell it eventually, Michael. I mean, let's be honest. Most of the people who are, yes, sure, some people pass it on to their children, but like most of the people who are buying assets at some point want to sell the assets at a profit. So let
me say it a different way.
Okay.
People that use fiat currency as a store of value, there's a name for them. We call them poor. Okay. Anybody that's rich in the world, they own property. They own large swathes of land. The royal family of England, it didn't sell all of its property in central London in order to buy, currency or paper money. Nor did the royal family of Japan. Nor did the royal family in the Middle East. In fact, they want to own the property forever. I want you to imagine Bitcoin is. It's a city in cyberspace that's 276 blocks wide, 276 blocks high, 276 blocks deep, about 21 million blocks. Now imagine all 8 billion people in the world want to live there one day. They want to put their capital there. There's $900 trillion of wealth in the world. As people migrate from every other form of property, and assets into cyberspace, you're going to see the Bitcoin network go from $1 trillion network to a 10x that to 100x that. And there really is nowhere else to go. It is the apex property of the human race.
So at some point, as the value of the Bitcoin on MicroStrategy's balance sheet grows, both because it's growing in absolute terms and maybe you're adding more to it, do you at some point down the line see being able to use it to transact, to invest in the business, to pay out a special dividend to investors, to buy other businesses?
We believe that the highest, best use of capital is to buy Bitcoin and hold the Bitcoin. The Bitcoin is going to appreciate in value faster than the S&P index. It's going to appreciate in value faster than commercial real estate. And so there's no point in selling the winner to buy the losers. And Bitcoin is the winner. And so we're just going to keep acquiring Bitcoin with our cash flows, with equity or capital raises, any other accretive method that comes to mind.
Something else I've noticed as I've talked to different investors, different analysts, is that MicroStrategy is actually trading at a pretty steep premium to Bitcoin itself. According to one analysis that I saw today, as much as 90 to 100% premium to Bitcoin. Is that justified, and why do you think it's justified?
Right now, an institutional investor that wants to buy Bitcoin has a choice of investing in the ETFs, of which BlackRock and Fidelity are very well known, or investing in some other company that has a Bitcoin strategy like MicroStrategy. You could think of the ETFs like ocean-going container ships. They can carry huge amounts of capital. You can invest $1 billion a day in the BlackRock ETF, so they could take on hundreds of billions of dollars of capital. They're not going to trade at a premium. But what they don't have is performance and leverage. MicroStrategy is different because our capital isn't, you can't redeem our shares. So it's possible for our shares to trade at a premium. We're an operating company, and that means when our shares trade at a premium, we can either raise capital through convertible debt or through equity. When we do that, we're doing it at a premium to the underlying assets. That captures an accretion for our underlying shareholders. So following a debt deal where we swap the debt for Bitcoin, our common stock shareholders have more Bitcoin per share than they did before the deal. So another way to say that is, if you want to pay 25 basis points and be 1-to-1 levered, then you would buy the ETF. But if you actually want to generate an accretion or a yield and not pay the fee and have leverage, then you would buy a stock like MicroStrategy. You could think of us as like, we're like air freight. We're Federal Express. We can take you faster, but we're never going to carry the same amount of capital in our payload as a supertanker or a container ship. So there's place for both of those strategies. And in fact, they're very complementary. I think the ETFs benefit from the existence of companies like MicroStrategy, and MicroStrategy benefits from the existence of the ETFs.
Yeah, certainly we've seen an uptick in adoption with the introduction of those ETFs. You mentioned the convertible offering. I am curious, because it's not the only offering you've done. Of course, you've done others as a way of investing in more Bitcoin. What happens if the price goes down again precipitously? What happens to the capital structure of MicroStrategy?
Well, you can crypto winner when Bitcoin went from 66,000 all the way down to 16,000. In that case, we simply hold the Bitcoin. Instead of being 20% levered, we become 40% or 60% levered. The way that we raise the capital is using convertible debt. And so the convertible debt is a unsecured instrument. It's not marked to market. It doesn't come due except in 4, 5, or 6 years from the point that we issued it. And it's not secured against any other kind of capital. So we don't have to actually do anything. We just wait for the market to recover. And that's what we did in 22. And in 23, we recovered, and our shareholders benefited from the deleveraging as Bitcoin rallied in the other direction.
Right. Obviously, that patience has paid off. Michael Saylor, thanks so much for the time. Appreciate it.
Yeah, thank you.
Thanks. Jared.
Yes, thank you for doing that, by the way.
Jared is ready.
I learned a few things.
Yeah. What are your takeaways from that conversation?
I've watched a few interviews with Saylor before, and I now appreciate. I think I better appreciate his position. Bitcoin maximalism on display here, and I liked his analogy with respect to New York City apartments. I would wonder if there's any kind of strategy to lend his securities out in the future, but that's just kind of a tangent. I think you really, at least enlightened for me, just kind of showed what he's about and what the strategy is. If we can go to the Wi-Fi Interactive, he was talking about his company, MicroStrategy, the leverage that they have on Bitcoin. This is MicroStrategy versus the Grayscale Bitcoin Trust, just as a proxy for Bitcoin since the beginning of the year. And you can see MicroStrategy went negative here. Grayscale Bitcoin did not, but in general, it's going higher and lower than the benchmark, which is Grayscale right here, which is actual Bitcoin. And that's just a function of leverage. And when you have a company like that, if he can ride out the Bitcoin winters and there's always hope for another spring, then yeah, well, it's a strategy that by definition works because it's based on the seasonal cycle, but you're always waiting and expecting for that next adoption. At some point, I think the market is going to become a little bit diluted, and just like the GLD ETF that we saw in 2004, you're going to see a saturation, and eventually people are going to have Bitcoin at a certain percentage in their portfolios, and that'll be it. At what price is Bitcoin then? I don't know, but I would think you need another strategy then.
Well, and the question is, how do you invest in it, right? And I think that's a really pertinent question for investors right now. You can buy Bitcoin itself, although not everyone has access to that, particularly institutions for various regulatory reasons. You can now buy those ETFs. You can buy something like MicroStrategy, right? Or maybe some of the other crypto-leaning companies. The difference between a MicroStrategy, which, as I mentioned to him, trades at a steep premium to Bitcoin, and an ETF is you're going to pay some fee on your ETF, say it's 25 basis points. That's a percentage. So as the price goes higher, the amount that you're paying goes higher. Yeah. So the argument is in favor of a MicroStrategy that even if the premium is steep now, that eventually over time you would pay more through buying an ETF.
It's an apples to oranges comparison with respect to investor protection. So from a regulatory point of view, I would say not quite the same there. So you're paying a fee for a service, which is that you can get your money out at the end if things go badly. You don't have the same protection with a company doing that.
Right. All right. Let's check on a few other trending tickers that we're watching right now. Archer Daniels Midland providing an update on its internal investigation led by the audit committee of its board of directors. And the company is making adjustments related to its reporting segments prompted by that investigation. Basically, what happened here is there were some accounting irregularities that the company had flagged here, and the revisions that it made to its numbers, the downward revisions, were not as steep as some analysts had projected. That said, the company said there are still some, it disclosed or confirmed, I should say, because there had been reporting to that effect, that there are subpoenas to some of its staff from the Department of Justice. So there may yet be more news on this, but for now, the stock is rallying on a little bit of relief.
A little bit. And let's go to the Wi-Fi Interactive where I can show, here is the price, and there we go. Here is the price breakdown. You can see there was a steep drop after that. That's that negative event we're talking about. Is all the news in there? Is it going to get better from here? We're seeing a tiny reaction, but we are still in the bottom end of this range. So I am not incredibly optimistic that we've seen the full story play out just yet, at least in terms of price. All right, On Holdings reporting earnings and guidance that missed street expectations. Shares sliding on the back end of lower than expected quarterly results. Let's get to Yahoo Finance's Madison Mills in on this discussion. Maddie.
Hello. Well, nothing's going to be as rousing as that Bitcoin interview, which I loved, by the way. Great job, Julie. That was really great. But to pivot a little bit, talk a little bit of sneakers here. We've got On Holdings having a tough day, their biggest one-day sell-off in the past 2 years. For anyone not familiar, this is a sneaker company. I was in a group chat about this company earlier today with friends asking if the company's pronounced cloud on cloud. So a little bit of brand awareness that they might have to work on here. But this was still their 7th quarter of record-breaking sales, but the pace is slowing, and we know that that is not going to be rewarded on the street. They were previously having quarters with 200% growth on their sales. that's going to be really tough to beat moving forward. So of course, the question to the executive team is how are you going to change that moving forward? They're going to try to go a little bit more direct to consumer, focus on the wholesale partners they already have as opposed to expanding to others. You can get these shoes at a Nordstrom, at a Zappos right now. They're going to stick with that and try to kind of go the direct to consumer route instead of adding additional names to the basket there.
I mean, there's definitely been a huge uptick in the ubiquity of these sneakers. Certainly if you're walking around New York City, there are a lot of people who have them. But I guess the question is, does it become like a Nike where people have multiple pairs or,
right.
Obviously you've hit sort of a pace that is maybe more sustainable, even if it's slower.
A saturation, potentially, right? And especially, I was thinking about Hoka's because the Deckers brand is the ticker that's going to be tied to that, up 35% over year to date, rather. On is up a little over 10% year to date. I feel like Hoka's is kind of their big competitor, at least when I think about the market of people walking around NYU here in New York City. And I just don't know how much brand awareness On is going to have compared to a Hoka's, which they definitely have the pricing power. The sneaker's a little bit less expensive and potentially very comfortable, things like that they're leaning in on. They've also got Roger Federer involved, so maybe they're going to lean into kind of expanding as a global athletic brand, but remains to be seen whether or not they're going to be able to take up that market share for the average consumer who we love to just be ourselves. Yes.
Thanks, Maddie. Appreciate it.
Julie. Thank you.
Well, shares of Southwest falling after the airline says Boeing delivery woes will prompt a review of its full-year forecast. We're going to take a closer look at the fallout in the airline sector more broadly next. With just over 10 minutes left till the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance playbook. Boeing's bumpy start to 2024 is hitting its customers. Several airlines looking to cut back on flights and temper hiring plans, citing uncertainty tied to fewer Boeing deliveries. With more on the impact, we're speaking with Helene Becker, TD Cowen Senior Research Analyst. Hey, Helene, it's great to see you. So we heard from Southwest today, and we've got tough language from the United CEO talking about not wanting the further out deliveries from the MAX 10 from Boeing. First of all, sort of big picture, how much of a problem is this for the industry now that they're probably not going to get as many planes as they thought?
Yeah, well, it's a problem because they can't grow as much as they originally thought, which I think investors, when they think about it, will appreciate. But demand is very strong, and we still have air traffic control issues, especially in the Northeast. And we really appreciate the FAA's comments recently that they are working on a college to air traffic controller program. But pragmatically, it limits the whole idea of not being able to get the aircraft you thought you were going to get. Means that there's going to be a cap on jobs, of course. United, Southwest, and a few other airlines, I think JetBlue is in that category, have all said that they've put plans to hire and train new pilots and flight attendants on hold. So that limits growth. And then, of course, going from smaller aircraft to larger aircraft doesn't help consumers because the larger aircraft gives you greater comfort in the planes, and it also enables growth at busy airports without necessarily adding service. So all in all, it really limits the opportunity for consumers and for corporates because I've always said, Julie, that without a robust airline industry, it's really hard to have a robust economy.
I think Warren Buffett might have something to say about that. I'm wondering, we have the headlines are grabbed by the 737 MAX issues, and we've seen problems with the 787 Dreamliner and other models over the last few years. How much of this is just a giant Boeing problem? And then what does that say as to the overhang of the industry? How does the industry crawl out of this?
Yeah, so I can't really comment to Boeing specifically because it's not in my coverage universe. But I can say that from an industry perspective, the airlines have done what they always do, and that's adapt. They are cutting their capacity growth. They're restructuring their order books. And that's really important. People don't think about that because as deliveries move to the right, you might have fewer aircraft deliveries this year. Say you were expecting 100 and you only get 50. That means 50 from this year slide into next year. And then at some point in the future, we expect that, and our analyst who covers Boeing does expect that they'll catch up. And so maybe in 2 or 4 years, you wind up taking delivery of 4 times as many aircraft as you otherwise would have, and you have to restructure the order book because no system can handle 200 deliveries in 1 year versus 50 or 100. You can probably handle 100, which when you think about it is still one roughly a week, one every 3.5, 4 days. So it's still a lot of capacity, but it postpones growth, and it means that airlines have to rethink their plans in that regard.
So, Helene, if investors are looking at airlines right now and trying to figure out where there might be opportunity, are those that are more reliant on Airbus to supply them with planes at an advantage? Is that where investors should be looking right now? Or are there still sort of Boeing-heavy airlines that are good investments?
Yeah, I think that's a good question. So we have Delta and United as well as Copa as kind of our top 3 choices this year. Delta and United kind of split their aircraft between Airbus and Boeing. And Copa is an all Boeing fleet. So, and that's a Panama-based airline, which has great growth and a roughly 6% dividend yield. So that's one that we like quite a lot. But going back to Delta and United, our view there is that they're very well positioned to grow internationally and domestically with the focus on larger aircraft. And of course, you heard, I think both Ed or Glenn at Delta this morning say that I guess Ed said earlier in the week that they expect the MAX 10 not to be delivered before 2027. And I feel like United said something similar, and that's why they've taken it out of the schedule. So I don't know that it directly answers your question, but both United and Delta are top picks. We recently upgraded American for the international component, and really that's how we're thinking about it. Strong international demand, recovering domestic. People are back in the office at least 4 days a week these days, 3 or 4 days a week, and we're seeing managed corporate travel increase again. So I think things are going well. I just think that nobody believes it. I think investors are skeptical. And remember, in the last decade pre-pandemic, we heard several airline managers say airlines will never lose money again, and that proved not to be too correct. So I think the market is rightly skeptical, but if the airlines can deliver on what they say they can, I think you'll see that reflected in the stock prices, over the next, say, 18 months or so.
Yeah, I think we'll see Berkshire buys Delta headlines sometime in the next 10 years. It'll be there, though. All right, you got to go. Really appreciate your time here, Lynn.
No worries, anytime.
While we were wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. Jared and I getting you up to speed on the action from today's session. So let's start with where the major averages ended up here. The Dow higher by about 236 points, call it about 0.2%, as we've been talking about after the CPI report this morning. Even though it came in a little hot, there doesn't seem to be a lot more concern about the Fed keeping rates higher for longer, or the markets don't seem as worried about it as you might expect. The S&P 500 looks like it's closing at a record here today, 51.7524, indeed beats the previous closing high from a few days ago, up about 1.1% on the day, and the Nasdaq Composite up 1.5% here on the day as well. Technology has been leading the gains that we've been seeing. As we talked about earlier, just wanted to check again on the 10-year yield here at 4.15%, rising on the day following those inflation figures. And what the heck, let's take a look at Bitcoin as well. We were talking about it earlier with Michael Saylor, down a little bit on the day, about 0.75%. Jared's got to look at the sectors for us right now.
You bet. And let's take a look, not on the travel sector right here. We want to get the sector large caps of the day. So tech, XLK, you can see in the upper left there, that is by far and away the #1 sector. It's also the only outperformer. That means it was carrying the bulk of today's gains. To the downside, utilities, the biggest loser, down 1%. That has been a winner recently, but real estate also down, interest rate sensitive sector, CPI going on, somewhat explains that. Energy and materials also down. And just real quickly, looking inside the tech heavy Nasdaq, Nvidia up 7%. Going to check a 5-day chart. Is it good enough for another record high? I don't think so, but my goodness, we're close and we're getting there.
Yeah, I'm also curious, don't you have your leading heat map,
yes,
like the leading indicators heat
right
map? Because I'm curious, as we see tech rally today, how some of those other sort of memey, buzzy things are doing.
Well, KWeb, that's Chinese internet. That's up 4.2%. We could look in there and see what the individual names are, but that is separate from the U.S. tech. They rally on their own fundamentals. Then second is software. And then we see New York FANG, that's really mega cap heavy, and then momentum, then the chip stocks. But if we look inside software here, this is a change that we've seen. You take a look over the last 5 days. Well, you don't see as much red as I thought you might have, but nevertheless, it has been under a little bit of pressure. And then the chip stocks also doing well today.
Yeah, definitely. That caught my attention too. Let's turn over to Yahoo Finance's Miles Udland for his top takeaways from the trading day. Miles, what are your top takeaways?
Well, you guys were just talking about the first one, which is if you look at the print we got on CPI this morning and then the reaction we got in the market, to continue the sports adjacent theme, I guess, of this program, trust the process, as some of our viewers might remember. And I think that investors right now are essentially continuing to believe, I guess, for themselves, I guess for their clients, just for the general 2024 story, which is that the Fed will cut rates and it will end up being fine. And a lot of what worked in 23 will work in 24. Well, that continues to play out. And I think you see that really in the sector action with the technology doing all of the work today, and the market cap gains that we've seen over the course of this year obviously make the skew there, let's say, on a sector basis, even more important for the index level move.
All right.
I'm curious about the second takeaway there with the real Magnificent Seven.
So
here we go. This is a fun part.
All right. So Jared and I were talking about this a little bit earlier, and he'd crunched the numbers, so we have a little divergence within Real Mag 7. But I think over the last few weeks, we have all circled this idea that Apple and Tesla are kind of out. Like, they have been laggards. I mean, Tesla's down for the year. They have been laggards relative to the guys in the Magnificent Seven doing a lot of the work, which is really Nvidia, Microsoft, and Meta at this point. So I'm proposing 2 new entrants to the Magnificent Seven. Eli Lilly, which is now, I think, the 8th biggest company in the S&P, something like this. Bank of America's note last week at $1,000 a share had it basically at $1 trillion market cap, about $950 billion. And the second is Costco. Now, Costco's, I think, 22nd right now in the S&P 500 on a market cap basis. But the reaction that we saw on Costco last week to that revenue miss, which was a small revenue miss, I think the stock was down 7-8% in a day. And that was a day where all the 2024 trades cooled off. And Costco has been at the center of don't worry, just buy it at 50 times earnings. It's fine. Everyone loves Costco. And it has taken on, mega caps are now, I don't want to say meme stocks, but there's a meme of just buy this mega cap theme. Costco continues to benefit from this premiumization, I guess, of consumer habits, and it's just a safe place that you can put money and you can tell someone, we're now overweight Costco. And everyone that is your investors can be like, that's great, I love Costco.
I love how you're stuffing a consumer staple in the Magnificent Seven.
It doesn't act like a staple. Look at the stock.
It just feels wrong to me to have Costco in there with those other companies.
So I was looking at this. I think there's also a discussion to be had about where Alphabet fits within the Magnificent Seven. I know Magnificent 3 is kind of where it's at, but
it's flat on the year. So where does it go?
Yeah.
I don't know. I will say this: when I was crunching the numbers, looking at the disparity between the old Mag 7, the new one with Costco and Lilly, it makes a difference. Going back to our chart, if you go back to the beginning of 2020, the Mag 7 original is up 155%. If you switch Costco and Eli Lilly, and it's up 171%, 171, but the Mag 4 is at 187%. So it just goes to show you, we don't need Costco, we don't need Eli Lilly. We need more concentration. We need the Mag 1, and maybe that's it. And that's where you go. That's how you take this to its illogical extreme conclusion. In case you were wondering.
Exactly.
The last takeaway that I should mention here is the last point on your screen, which was the most important dot plot ever. Is that since the last dot plot, or are you being?
No, I'm
are you
serious.
not being? Wait, are you, Miles, not being facetious?
I think next Wednesday's dot plot is the most important dot plot the Fed has ever released.
Explain.
And the reason why is that when they came out in December and they said, we're going to cut rates 3 times in 2024, the market said, all right, we'll buy that. We think it's going to be 6. And over the last few months, there's been a convergence. The market is now at 3 to match the Fed. In that time, the S&P is up 7-8%. We're just talking about all the action in the Magnificent 7, 4, however many stocks, right? All those memes are still in play. Now you're getting software is rallying, Chinese tech stock, like everything's great in the market on the condition that the markets still believe the Fed will cut rates 3 times. If they come out next week and they say, we're going to cut rates once, I think you are then having a conversation about, are we getting to the June dot plot and discussing rate hikes or no cuts this year? And I think a lot of what the market has become comfortable with in the last few weeks is that this is delayed gratification, not removed reward, essentially. And if the Fed comes out and suggests that there's a wholesale change in how they're approaching rate cuts in 2024, then you could be like, all right, maybe we've got a problem here.
Just one quick note on that, too, that I think is interesting. Jay Powell really downplayed the dot plot at certain times in the past. But it feels like maybe that was the wrong call. Well, because it turns out the dot plot actually was the more accurate read.
And if you look at his testimony last week, he did the same thing, right? He's trying to downplay it. And I think the reason he's trying to downplay it is because he knows that it has only risen in importance. Like, the thing is, if you look at 23, the Fed's dot plot told you they were going to be more aggressive, told you they were not looking to cut rates. And while he wants to back away from that, it has been a pretty good guide in the last couple of years. So what they say next week, markets correctly will probably infer it's going to be a guide for what happens the balance of this year.
I like your thinking. We had some fun earlier, but that's some serious deep dive thinking that...
I know the whole thing is like, I'm always kidding and I don't mean it about anything, but like I actually think
this is how you got to head of news.
Exactly. For whatever that is. I mean, is that title serious? I don't know.
Yes.
All right. Thank you, Miles. As the majority of analysts price in Fed cuts in June, following today's higher than expected inflation data, our next guest is warning that we can't expect a soft landing just yet. Jeff Klingelhofer is Thornburg Investment Management Head of Investment, and he says the longer the Fed waits, the bigger the risk, and he's joining us now to explain. So you got the floor, my friend.
I think the conversation's just been fascinating, right?
Thank you.
I agree completely. Next week is an incredibly important Fed meeting, but really it's just a continuation of what the Fed has already been telling us. They have to see inflation come down. A prerequisite to their own belief of seeing inflation come down is they have to see the consumer weaken. And as part of that, they have to see the unemployment rate move up. So the big story that we've been facing for the last year and a half now and continuing into 2024 is the resiliency of that consumer. But when you peel back the onion, you see all sorts of signs that just don't make sense, and they don't jive with the very high level strength that we're seeing. So you see a divergence in the household employment survey versus the establishment survey, right? They go in very different directions. Gross domestic product, GDP versus gross domestic income, telling two very different pictures. But the one that I can't square, and I think really points us that the consumer is in a much weaker spot than we're being led on to believe, is while yes, employment remains strong, they're depleting COVID stimulus. They're continuing to consume, but they're taking on more debt in order to consume, and they're defaulting on that debt at a higher level. And that's usually one of the leading indicators to a fall in sentiment and ultimately market stress.
Okay, so following on our conversation we just had, do the dots go to 1 cut this year? And if they do, and what you say is true, how alarming is that?
I think it'd be very alarming, but I don't think that they do next week. Right? The Fed also has a tenuous balance. They're trying to get inflation to come down, the miraculous soft or even no landing, what we're currently pricing as a market. And I'll give it to the Fed. They've been successful thus far in doing exactly that. But they themselves know that the economic textbooks that we all studied, we all learned from, the alchemy of low interest rates is over. Higher interest rates are having an impact. It's not only having an impact on the consumer, it's having an impact on corporations as well, right? Their borrowing expenses are increasing. It took a lot longer to get there than we would have imagined as companies termed out their debt. But the exact same side on the deficit financing side, the government's balance sheet is also having an impact. Right? There's over $10 trillion of debt that has to roll over this year. That's more than a third of GDP. And so all this comes to culmination. The Fed has a very difficult balance. They're not ready to signal that to the market, but they will.
We've seen Powell, he's switched gears a number of times. He's pivoted a number of times historically and pretty quickly. I'm just wondering, do you think the potential is still there? And the reason I'm asking, he has been channeling his inner Volcker for some time now. And then you look at the charts of the 1970s of Volcker, where you got that double dip like that. Well, we're at the bottom. We've done one. Do we get another? So I guess my question for you is, do you think, you look at the inflation data today, have we seen the worst, or are we accelerating to the upside? Because that kind of informs everything we're talking about here with respect to the Fed.
Well, just to continue the conversation, using a sports reference myself, I'm a tennis player, right? I think what the Fed is trying to do is to avoid the unforced error or the foot fault. Right? They're starting to see, and most inflation metrics that you focus on, we're lapping the easy side of inflation. And to your point, we're coming back into much tougher sides, right? So energy inflation is actually going up. The average consumer is feeling that pain. And I think that's exactly why, while I don't expect the dot plot to move next week, in coming months, I do expect it to, because inflation will remain firm. We're seeing that we're firmly anchored at 3%, and we're not going to continue to go lower. If anything, it might actually start to move higher.
So what does all of that mean for where the market's going and where you should be? Because you sound a little more defensive than some of the folks we've been talking to. How are you expressing that?
Yeah, I don't term it necessarily defensive in terms of saying we're absolutely heading towards a recession, but the signs are there, but it doesn't match up with market valuation, right? So PEs are near all-time highs, right? Credit spreads are near all-time tights. We combine that with there are emerging signs of weakness in the consumer. There are signs that corporations, there was just a survey out this morning, small businesses plan to hire at a much lower rate than they have been in the past. And this has real impacts on the economy and markets. And so where I am is really playing defense for our investors. On the equity side, focusing on companies with big moats around their businesses, focusing on defensive dividend paying companies primarily within the Eurozone and international space, and on fixed income, taking advantage of that inverted yield curve where you can get 6-7% relatively easy and in very defensive portfolios.
All right, Jeff, thank you.
Yeah, well, we have to leave it there, but a lot of great insights. So thank you for helping us continue that Fed discussion as always. All right, coming up, the House to vote on a bill tomorrow that gives Chinese company ByteDance an ultimatum: sell TikTok or face a ban in the United States. More on that when market domination over time returns.
The House is voting on a bill that gives Chinese company ByteDance an ultimatum: sell TikTok or face a ban in the United States. But how likely is it that ByteDance will sell? Who would take control if it did? Here to help us answer these questions is Axios pro-tech policy reporter Maria Curie. And Maria, there's been some reporting now also that ByteDance says it's going to fight this if the bill does indeed get passed. But, you know, I think there are a lot of questions about how this would all play out, even if the bill does get passed. So what are you hearing?
Absolutely. So they have already been fighting this. To be clear, they have creators here on Capitol Hill, where I am now, just outside the House of Representatives, lobbying against this and speaking out against this. And they've been meeting with lawmakers as well. They will continue to do so tomorrow. And even though this bill has moved very quickly through the House, it was just introduced and passed out of the committee level last week. Now it's being expected to pass tomorrow. It still faces a long road ahead in the Senate. And then even if President Biden does sign it into law, which he has indicated he would, it will immediately be challenged by TikTok and ByteDance in all likelihood. And then it would get caught up in the courts, likely delaying that 165 divestment period that ByteDance has to sell TikTok. And then from there, we can get into the different companies that have been floated as potential buyers. There are some that would make sense, beginning with Microsoft. If we remember, under the Trump administration, when former President Donald Trump tried to force divestiture through an executive order, he actually gave ByteDance 45 days, so much less than 165 days. But as we know, that did end up falling through.
Let me ask you, what are the legal differences between that executive order that President Trump issued way back in the day and this bill? This would be a law passed by Congress. What kind of weight does that carry versus the executive order? And just for the general, I guess, just generally thinking about the likelihood of it actually coming to pass.
Right. So an executive order legally is flimsier than a law passed by Congress. An executive order could be reversed just by the next incoming president. That being said, we have seen that at the state level, legislation has pretty immediately faced court challenges. I'm talking about Montana, which did try to ban TikTok, and that was frozen. It never went into effect, and it's going through the courts right now. This bill is different from the Montana bill. Its sponsors are arguing that it's not an outright ban, it's a divestiture requirement, but it still faces constitutionality concerns, First Amendment concerns, and Bill of Attainder concerns, whether or not you can come after an individual or a group of individuals without trial. Even then, if it does clear all of those concerns, there are questions about antitrust. And if another social media company were to purchase this app, is that a monopoly concern? China could also come in and try to stop this and block it. So it definitely faces an uphill battle, but this is still the most energy we have seen since TikTok's CEO, Shou Chew, testified before the House to get something done. So it is notable.
And Maria, let's say that it did pass and that there wasn't a divestment and there was an attempt to actually ban it. I mean, we saw this play out in Montana to some extent, and then there were some legal challenges. But technologically, how would it even work to ban an app?
That's a great question. So the primary concern right now is with the data itself, like U.S. data and whose hands it's in. And Oracle right now has control in its cloud services of American data. That hasn't been enough to please lawmaker concerns that the Chinese government could still step in and have all that data be, transferred over to China. But it is in the hands of Oracle right now. That's a $1.5 billion investment that ByteDance and TikTok made into Oracle. And so another question is, what company is going to want to continue that? And Oracle itself is another potential buyer that has been floated. They haven't come out and said anything, but they are seen as a viable candidate.
All right, a lot to chew on there. Thank you for stopping by, Maria Curie.
Thank you.
Last Friday's job report continuing signs of strength in a labor market many were expecting to cool in 2024. Now economists are feeling increasingly better about the outlook for economic growth. And for more, we're bringing in Yahoo Finance's Josh Schaefer. So what do you got on deck for us here?
Yeah, Jared. So a couple of economists coming out and raising their GDP forecasts after last Friday's jobs report, taking in basically now that we have several months of stronger than expected labor data. They think that that's providing perhaps a higher floor to where we could fall in economic growth overall this year. And what you're looking at right now is the overall consensus projections. We have projected quarter over quarter growth of 0.6% for the first quarter. That's now up to 1.8%. Again, that's quarter over quarter GDP growth for the first quarter. But a pretty massive move there, guys. And this has been sort of the theme for the overall economic data that we look at this year. It hasn't just been economic growth that shifted from consensus. It's also been inflation expectations. When you zoom back 2 months ago, the broad consensus on Wall Street was inflation's falling faster than we expected. We're going to get a Fed rate cut in March, and we might get 6 rate cuts this year. Well, now we're redoing that forecast as well. Inflation's maybe stickier than we first thought. And we're also redoing the Fed rate forecast, right? We're now looking at possibly June, maybe 3 rate cuts, maybe less. But the key takeaway from that right now is markets have held up. That's what we saw in the market action today. I know Miles was making this point earlier, but essentially looking at this and taking away that we're going to get 3 rate cuts seems to be okay for investors right now.
For the moment. You know, Jeff Klingenhofer was also talking about the conundrum here, that the economy has defied expectations, that it's puzzling what exactly is going on. And he was talking about some of the signs that the consumer might be slowing down. So I'm curious, in your reporting, what are some of the risks that are still being flagged?
Yeah, I mean, I would say honestly, Julie, the biggest risks it seems like people are finding right now would be the overall macro risk that the economy keeps outperforming. So we don't get a Fed rate cut, and then people are still concerned that the lags. The lags are going to come eventually.
Oh, those long and variable lags.
If we keep the restrictive policy there, people are going to keep waiting for the lags, right? And I think that's the main concern, is there's no signs of economic growth completely falling off a cliff right now. Yes, there are signs in maybe a weakening consumer, but there's not, say, labor market signs that are flashing yellow or maybe even flashing red at this point. People's concern would be if this strong economic growth stays, and so the Fed doesn't cut it all this year, what does that eventually do? And also from a stock perspective, what does that do to a lot of these stocks that people sort of have baked in that we're going to get at least a rate cut or 2, right? Some of these soft landing trades and the broadening out we're seeing is counting on some level of the Fed cutting at least a little.
I got to tell you, if you're a stock, I pick on Peloton too much, but if you're Peloton and you're holding out for that Fed rate cut as the one that's going to get you back to break even from 3 years ago, that's not going to happen. But Josh, we got time for a little bit more. What's on your radar for the rest of the week? Anything you're watching in particular or writing about?
I think it'll be interesting to take a look at PPI as well, Jared, right? We know that sort of reiterated what we saw in CPI last month. Do you see that sort of carry through? And then the other takeaway I had from today that you guys were talking about as well, we were just talking about the potential broadening out or not broadening out. I mean, today we just saw another tech-led rally. What do we see? We have 3 more trading days left this week. What do we see? Do we see further signs of broadening, or are we going back to complaining that tech is leading the S&P 500 higher and no one wants to buy?
It was literally tech, because people say tech, consumer discretionary, throw it in, communication services. It was literally only tech today.
Nvidia up 7%, Jared. Yeah. I mean,
that's all it takes.
We can just cover Nvidia for 2 hours.
We pretty much do.
We have. Josh, I'm sure we will again. Thanks a lot, Josh. Time now for What to Watch on Wednesday, March 13th. Starting off on Capitol Hill, the House voting on a bill that would require Chinese company ByteDance to sell TikTok or face a ban in the United States. Now, if that bill passes, it would go to a vote in the Senate, and if it passes there, it would go to the president to sign into law. President Biden saying that if the bill gets through Congress, he will indeed sign it.
And moving over to earnings, Lennar, Dollar Tree, and Williams-Sonoma all reporting earnings tomorrow. Lennar announcing results for the first quarter of 2024 after the closing bell. Now, the home building giant having a strong start to the year. It's up about 11% as home builders continue their upward trajectory. And let's go to the Wi-Fi Interactive real quickly, where I have our home builders year-to-date looking. And I should mention, home builders have been making, just XHB, that's a sector itself, have been making record highs, but you can really see, especially over the last year, some of these outsized returns.
Yeah, definitely. We've seen a lot of optimism about housing coming back. Speaking of housing, by the way, new weekly mortgage application data is coming out in the morning. The latest reading showing a sharp increase following weeks of declines. This coming as mortgage rates hover around 7%, showing the spring buying season might be showing some signs of life. So obviously you're looking at Lennar as one of the things that you're zeroing in on. Kind of on a related note, Williams-Sonoma is going to be reporting. That stock has been a monster over the past year. It's actually more than doubled. It's up about 20% year to date, and it is trading near a record here. What's interesting is as you go into this quarter, analysts are forecasting that almost all of their business lines are going to see a drop in comparable sales, except for Pottery Barn Kids and Teens. That's kind of been what's going on for the company, but it has not been dropping prices. So its margins have held up even as sales have not. We'll see if that theme continues.
Well, if their margins have held up so far, it should be a great year for them, because this is a year that you might actually see sales increase as well. But just looking at real quickly at the year-to-date interactive on the home improvement sector, we can see Sonoma up 20%, and that's one of the leaders on this board. As you said, over the last year, it's up 100%.
Yeah.
So a lot more impressive there.
Yes. All right. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Stay tuned. We've got more Yahoo Finance on the other side. Talk of a Paramount takeover back in the news. Private equity firm, and we should disclose our parent company, Apollo Global, reportedly reaching out to the media giant about a potential deal. That's according to Axios. Alexander Canal's been following these developments. I mean, we're saying it's back in the news. I feel like it never left.
I know,
right?
I was like, has it left? I feel like we've been talking about this.
But this is a new name to be thrown in the ring. There have been a lot already that have been talked about.
Yes, there's been a lot of reports, a lot of discussions and conversations. We don't have anything concrete yet, but according to this Axios report, Apollo did reach out to a special committee that Paramount has formed when it comes to a possible deal there. They reportedly discussed either a possible takeover or asset purchase. Now, experts have told me that private equity, there's a lot of cash sitting on the sidelines. They have a lot of capital to deploy, and they're looking to do that in strategic ways. Apollo is not the only private equity firm whose name has been flown around there. There's also KKR, Redbird Capital. We have David Ellison's production company, Skydance Media, along with media mogul Byron Allen. He's reportedly interested on the linear network side of the business. And then Warner Brothers Discovery, that was a very big company that was mentioned potentially to combine with Paramount. Those talks have since stalled, according to Axios, but we'll see. Potentially that could pick up again. And it's really a big question mark for Paramount when it comes to the future of its business. It has a lot of debt. It's struggling with its stock price. We did reach out to both Paramount and Apollo Global for comment. They did not have any for us today. So just a continuing saga, a continuing story. And then, of course, there's a regulatory question, right? If there is a deal that comes down the line, will that receive approval? So, just another day in the world of media.
Yeah, exactly.
All right, Allie, thank you for that. And we want to stick with the shareholder conversation here. Disney delivering its latest blow amid an ongoing proxy battle. The company getting professional in a video criticizing activist investor Nelson Peltz, attacking Peltz and his partners personally. Peltz's Trion partners called the video statements false and misleading, pointing to the stock's lackluster performance in recent years. Now, to better understand the broader landscape and goals of such activist investor fights, we are joined by Bruce Goldfarb. He is the Okapi partner, CEO, and president. Thank you for joining us here today. So we talk a lot about shareholder activism here, but maybe kind of give us a backstory or some behind-the-scenes view of what's actually going on and why we come up with these votes and how we come up with these votes in the first place.
Well, great to see you, Jared. Great to see you again, Julie. Activism is when investors start to say, I'm not happy with the price of the shares that I own. There is something that can be done to make the share price go up. And very frequently, that means we have ideas about the plan. We believe there can be better board oversight of the company, board members who can solve problems. And we are seeing that in droves this year. And companies like you've mentioned, Disney, and we saw it with Starbucks, and we are seeing it just settled now with Advance Auto Parts, and then there's Norfolk Southern. The reality is, activism means an investor is saying, I'm going to put my mouth where my money is, and I'm going to fix problems that haven't yet been addressed. And we're seeing that now, and shareholders are cheering it on, whether it's large institutions or retail investors.
Bruce, now, if I have it right, Trion is your client in this particular situation.
That's right.
So I don't know how much you can say, but I'm going to ask you about it anyway. This has gotten pretty contentious, right? I mean, and Disney, with all the power of its media might, has been on a campaign. They put out a cartoon. They put out some new material. In the face of that, how do you advise your client to be successful when, and both sides have been getting a little bit personal and nasty, one could say?
Well, you're right. There's only so many things that I can discuss that we talk about in terms of strategy, but let's appreciate that the messaging that Trion puts out is very accurate. If you own shares of Disney, you have lost value, and that there are actions that need to be taken to restore that value, to restore the magic at Disney. And effectively, it goes from the oversight level, and it's really great when companies can talk in generalities of what they're going to do, but it's about execution. And that's what activism is ultimately about. It's about the execution of a plan or the ideas that haven't been thought through. And I really can't say something that Nelson and the Trian team haven't said so effectively already about this, Julie.
Would there be any actions that Disney could take that would get Trian to back? I mean, because they have been, I mean, you talk about it is about execution, of course. They have taken some actions so far.
Well, they've made steps towards taking action, and that's why there was a proxy fight last year that was pulled back. But it's about follow through. And what can be taken this year? It seems that a lot of shareholders are saying support Trian and put some new people on the board.
I'd like to take a step back here. Just in general, think about the role of passive investing and the role that has made on shareholder votes, because you have a company like BlackRock through iShares having incredible sway over the proxies, over the potential direction of these companies. Do activist investors consult with some of these big ETF producers, and how critical is it to get them on your side?
That's the right question, because it's all about figuring out who your shareholders are, how those shareholders think, and how they're going to vote. And so part of our job as an investor response firm is we bring our clients to these investors and we allow them to express their message and understand the process in a way where they can take action and vote. Now, ultimately, the largest institutional investors like BlackRock and Vanguard and State Street have very big sway. They own big positions. What's been very interesting in the last year or so is they've taken those positions, and BlackRock has sort of had this concept of allowing investors to make their voting choice. And so we're seeing institutions who manage money with BlackRock making their own voting decisions. We're seeing individuals now go out and make their voting choice if they care about the process. The big challenge always is with retail shareholders, how do you get them to overcome their apathy and vote? And so part of what we do is we reach out to the retail shareholders. And you talked about messaging, you talked about cartoons and video and social media. We're making phone calls, we're sending letters, we're working through with social media to reach out to people to get them to vote.
On the behalf of companies?
We do it on behalf of companies. Lately, we've done it on behalf of investors as well.
So, because I'm curious about that, because there was a story today in the Wall Street Journal about more Americans than ever owning stocks. But they're not voting, to your point. And traditionally, I have the sort of concept in my mind of companies not necessarily wanting people to vote. They make their shareholder meetings in obscure places. It's difficult to get to. It's not as accessible. Has that improved in your view?
Well, it's changed. So, for example, meetings aren't always in obscure places. They're right on your computer.
Right.
Very few companies now actually have a live meeting. And in some instances, that's maybe a change in the system that's imperfect. On the other hand, every shareholder can figure out a way to attend the meeting. The key is not attending the meeting. The key is to express your opinion and vote. And you're also correct that individuals are largely apathetic toward voting. And when institutions own most of the shares, maybe it doesn't matter. But when you have certain companies that are widely held, owned by individuals, 20, 30, 40% of the shares, each of those votes matter, and it becomes critical to get the message out. And we've seen changes in how we reach out to people, but we've also seen changes in how they have the ability to vote. There's more online voting. With a proxy fight, you have a universal proxy card, so you can pick exactly who you want to be as your nominee.
Bruce, good to see you. Thanks for coming in. Appreciate it.
Thanks.
Well, coming up, Campbell Soup has completed its acquisition of Sovos brands for over $2 billion. Stick around. We'll hear from the CEO of Campbell, Mark Klaus. He will talk to us on the other side to discuss the deal and much more. McDonald's, Wendy's, and other fast food giants are vying for diners' morning dollars, duking it out when it comes to enticing customers at breakfast time, as foot traffic has declined since the pandemic, but not all are getting sweet results. So Brooke De Palma has been digging into new data, joins us now. So where are people going for breakfast?
Good morning, good afternoon. I'm thinking morning, I'm thinking breakfast. Good afternoon, Julie. McDonald's is still taking the cake here. It's important to note that McDonald's does still dominate the breakfast game with their coveted Egg McMuffin, really a known brand among so many consumers. They currently have roughly 35% of total market share here when compared to other fast food chains, coffee, breakfast, bakery, and dessert shops when compared to all those. And that's followed by longtime breakfast players Starbucks and Dunkin'. And then a newcomer, Burger King, holding 4.4% of share, leading into value with its March promotion that customers can get a free breakfast item with any purchase of $1 or more. That's then followed by Wendy's. Now, Wendy's really doubling down on increasing morning visits. They introduced breakfast back in 2020, and they're now investing $55 million in advertising in the U.S. and Canada to increase those sales, the morning day part. That's followed by Taco Bell. They currently have 1.9%, but they're leaning on innovation with breakfast tots as well as value offerings like the Bell Breakfast Box. But all these companies are really looking to tap into a new customer here, not necessarily take away a customer from another day part. And the street thinks that this addition could really benefit companies. They could see incremental foot traffic here. Once again, additional foot traffic, not taking away from another day part. Perhaps someone who's looking to step away from that pricey brunch and also still go out. In addition to that, breakfast requires lower staffing needs, and you're tapping into lower cost food. Think eggs, think bread. But execution is really key here, given the additional inventory that's needed. You also do need staff to man these hours. They need to make sure that there is a sufficient demand here in order to make sure that margins don't deteriorate here and make sure that it works out.
Taco Bell breakfast. I have yet to take that plunge. Sounds interesting, though. Thank you for that, Brooke. Campbell Soup Company announces the completion of its acquisition of Sovos Brands. Yahoo Finance had the chance to speak with CEO Mark Klaus on this milestone in Campbell's history and the opportunity ahead with Sovos Brands. Take a listen.
Yeah, it's an exciting moment. I think in many ways there's not a lot of times where you've got a billion-dollar business that is the real growth engine in an industry that strategically fits perfectly within our portfolio. So it really is a bit of a match made in heaven. And look, the first 60 days, obviously, in any acquisition, you're spending a lot of your time and energy on the people, right? You want to make sure that those great team members from Sovos are finding their way into the Campbell's family. And we've got a great plan. You would have seen today we announced that we're bringing over one of the key leaders in Risa from the Sovos team, and she's going to be leading the distinctive brand segment within the meals and beverage business. She has a tremendous history, led the Raos business through a lot of its growth. Actually used to work for me on the Pinnacle side, leading the Bird's Eye brand. So good to have her back in the family. But a lot of that time spent on the people. But the second thing I would just say is one of the beauties of this acquisition is really we're just trying to extend and continue to execute the Sovos playbook. The team has done a masterful job. And so we're not expecting any changes or shifts. It's just really about stepping on the accelerator and continuing to drive a strategy that really looks like it's working well.
Do you think the brand last year, I mean, the sales were off the charts, Mark, I mean, up 25% year over year in terms of sales. Do you think it still grows at that rate this year?
Yeah, I mean, look, the reality is the 2-year growth rate 67%. So this is a business that has just really been on fire when we think about where Raos has gone. And again, it's just a terrific testament to the Sovos team. And I think that the good news is when I look at that more recent trends in growth, here's a couple things I see that are really encouraging. First, The growth is being fueled by both distribution and velocity, while also seeing continued expansion of household penetration. I love all three of those variables and glad that it's not singularly dependent on any one, but that the opportunity to demonstrate all three is a potential for growth. Two, I am really excited about what the team has done on the frozen side, right? This is not an easy category, and they've been able to come in with a differentiated, more premium product, and the velocities on those new items are extremely compelling. And, maybe a little closer to home, their super premium soup offering is also doing very well, adding a point of share growth right now within the world of soup to our portfolio. And it's going to be a wonderful complement to, again, our mainstream business, very differentiated but complementary to what we're doing on brands like Chunky and our condensed soup business. So I think the good news is that although that growth is sustained, it continues to demonstrate the expandability. And even with that growth rate, I can still see a very, very long runway of opportunity ahead.
Mark, true story. So ahead of this interview, 2 nights ago, I went and just bought a bunch of your products. I put them on my table at home. The cans look the same. A lot of the products, from what I could tell, they all taste the same as when I remember 10, 15 years ago, whatever it was. There's a lot of debate in this country right now about shrinkflation. I see it down the cereal aisles. I see it from some of your competitors. What's your philosophy on this happening? Because I think even the president weighed in. What's Campbell's philosophy on shrinking packages and taking ingredients out of their products?
Yeah, so look, I think a couple things that I would just say. The first thing that I would say is we all need to understand and recognize that as much as within the visibility to macroeconomic trends, there may be a lot of reasons to be encouraged and to feel like there's positive momentum, and there is in different areas and different variables, which is ultimately encouraging. But we've got to remind ourselves that many of the consumers in this country have spent the last several years in an unprecedented level of inflation. They're dealing with higher credit card balances. And although interest rates may have improved, they're certainly not down to the levels that they were historically. And so this consumer base has really been finding it tough. I mean, in fact, 8 out of 10 consumers, if you ask them today, are you better off than you were a year ago, would say no. And so I think our job as food companies, as much as it is a diligence and a requirement to ensure that we're doing the right things from a profitability and sustainability standpoint, that we're doing also the right things to maintain affordability. And so when we think about that in the context of the world we're in, there's a lot of different tools that can be used. But what we will not do is lower the quality of our products or lower the expectations of what a consumer might have when they open a bag of Milanos or they're having a bowl of Chunky soup. We will protect that at all costs. It's important. And by the way, let me just add for our new entrance into the family, we will not change the sauce of Raos either. This is going to be about maintaining and protecting the quality. Now, we very rarely change sizes of packages because it's not always the easiest area to execute, but there are certain moments where a particular price point on a large size or something may be part of someone's tool bag. But at the end of the day, what we want to do is ensure that we're, one, thinking about the needs of the consumers and staying affordable and relevant, while also being absolute gatekeepers on protecting the quality and the expectations that consumers should have when they open a Campbell's product.
Well, thank you for leaving the beef in my Chunky soup. Mark Klaus, congrats on this deal. Always nice to get some time with you, Campbell Soup CEO. We'll talk to you soon.
Great, Brian. Thank you.
Much more ahead on Yahoo Finance. Do stick around.
Two new studies show Americans are striking a more optimistic tone when thinking about retirement. Yahoo Finance's Carrie Hannon here with the details. Carrie, great to see you. What are the details?
Hey, yeah, great to see you. Well, for once, we have a little good news about retirement. The Vanguard study shows that more people than ever they have been setting aside money in their retirement accounts at increased levels. So more than 4 in 10 increased the amount they set aside last year. And what a great year to do that, right? So the average balances now in their plan participant accounts were up 19%, which is just phenomenal. There's two reasons why that sort of jump up in contributions to the retirement accounts is. One is, yes, people did it voluntarily. They're getting the message. The second one is auto enrollment. More employers than ever are offering automatic enrollment, so people don't have to voluntarily decide to go into their retirement accounts when they start a job, and also auto escalation. So each year it ramps up without anyone having to make a decision to do that. That's great news for savers. The other good piece of news came out of Fidelity. So Fidelity found that 3/4 of Americans are now confident that they're going to be able to retire on their own terms. Now that's great news, right? And the fun thing is that 2/3 of them say that they're looking forward to working for fun in retirement. They're still thinking about retiring between the ages of 61 and 62 when they're still healthy, but most of them are planning to work part-time, and that warms my heart because I'm a big fan of work. And so that's really encouraging news for savers. Now, the one thing, I want to say this is all great news, and of course that is, but there was a little bit of a red flag in the Vanguard report, and here's that. More people than ever raided their retirement accounts and made a withdrawal. So it's 4%. That's the highest level that Vanguard has ever found in the tracking this number. It's a small percentage. Okay, great. But the point is it's up, and it may be for financial needs. Primarily, this is for financial emergencies. But here's the thing, people have to remember that if you take that money out before you're 59 and a half, you're going to pay that 10% penalty, and you're going to pay tax on that amount as well. So that's an issue that I think people need to pay attention to. There are some exceptions.
Carrie, great to see you as always. Thanks a lot.
Thank you.
And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Jared, thanks for being here.
Thank you for having me.
Have a good night.